Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, Speaker Kevin McCarthy says the House could vote on a debt ceiling deal as soon as next week. Senator Bernie Sanders says if Joe Biden makes concessions with the Speaker, he and other progressive senators will vote no and want the president to invoke the 14th Amendment. What will the stock market do if we don't get this deal done? We'll discuss that with Jeff Kleintop. He's the chief market strategist for Charles Schwab, and he says we're already in a recession. Well, then how should we invest? Target and Walmart released their earnings for last quarter, and while the people were buying goods, you'll be surprised at the amount of those stealing goods through shoplifting. I'm Andre Laborde. We've got these stories and more. So sit back and relax. Let's have 30 minutes together. It's Friday, and it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up for this Friday, May the 19th. Well, how did our money do this week? It was a down day, but an up week for stocks. Stocks fell late in the day as debt ceiling worries resurfaced. Top stocks for the S&P were Adobe and Cisco. All three stock sectors ended the week in the positive, and the laggards in the S&P were Etsy, Ulta, and Nike. And this week, the Dow Jones closed today at 33,426. That was up about 0.4 of a point for the week. And the S&P 500, they closed today at 4,191, up 1.6% for the week. And the NASDAQ, they closed today at 12,657, up just over 3% for the week. Well, the debt ceiling, are we in a recession now, and where to invest during these uncertain times? Jeff Kleintop, he is the Chief Global Investment Strategist for Charles Schwab, and he's here with us tonight. Hi, Jeff. Welcome to Wall Street Wrap-Up.
Thanks for having me on. Great to be with you.
Jeff, right now, what's front and center in Washington, D.C., at least, is the debate over raising of the debt ceiling. How important to Wall Street is this topic of whether or not that they will be raising, or when will they be raising the debt ceiling?
You know, it's a critical issue. A default or a funding delay in the U.S. Treasury market, which is the deepest and most liquid market in the world and a central component of the global financial system, would have global impacts were it not to be dealt with. We still expect a last-minute debt ceiling increase that may avert a crisis. That doesn't mean debt isn't still a problem, but it may avert this issue of a funding lapse in the Treasury market, or the potential for delayed payments into Medicare or Social Security, or government staffing or shutdowns. We all want to avoid those problems. We all remember what happened perhaps back in 2011 when it really upset the markets, and we saw actually a downgrade of U.S. debt by one of the rating agencies. We don't want to see a repeat of that again.
Jeff, that's a good point, because I think it was just like you said, it was August of 2011, and they had the downgrading by the rating agencies, and for doing that, and the markets dropped quite a bit.
So that's the risk, and that we see whether it's rating agencies or foreign governments pull back from wanting to hold treasuries because of this potential ongoing risk associated with the debt ceiling. You know, it's funny, there are few other nations with a debt ceiling. There's really no other countries to look for as to a guide on the impact of a debt ceiling driven crisis. Australia abandoned their debt ceiling in 2013. I think only Denmark, Poland, Kenya, Malaysia, Namibia, and Pakistan currently limit the amount of government debt. So we're in rare company, to say the least. So it's difficult to say exactly what would happen. It's unlikely that we'd see a mass movement away from treasuries. In fact, you might even see the treasury market rally in the event of a crisis because of the fear that it might bring to the markets of a deeper recession and the flight into treasuries.
Lately, we've had the jobs report that came out with some very good numbers. We had unemployment that had gone down, and also job increases. We recently had the CPI, the Consumer Price Index for April, come out, which was below 5% for the first time, I think, in 2 years. Now that's good, but we've also had the other news where banks have been having problems because they've been investing, like you were just bringing up about, in treasuries. So we've had both good and bad news. Do you think that with the Federal Reserve, when they meet again in June, do you think they're going to be looking at maybe increasing again to another 25 basis points? Do you think they're going to pause, or do you think they might even reduce?
It seems like they'd like to be on hold, but it's dependent on so many factors. Each data point, as you note, whether it's events in the banking world or developments on inflation or the labor market, are pulling in different directions. And so it's a very tough decision. I think that we're likely to not see the Fed be able to declare victory on inflation and say definitively that they are not going to hike rates again, simply because of the volatile nature of inflation. You know, looking back, we've almost never seen inflation when it rises come down in a straight line. Remember how COVID came in waves? Inflation could come in waves too, and for a variety of different reasons. And as a result of that, I think that might keep us on the edge of our seats with each meeting this year as to whether they'll hike or keep rates stable. It's interesting to note that the market expects 3 rate cuts later this year, bringing rates down by 75 basis points. I think that's maybe too optimistic an assessment.
So if they raise rates again, that means interest rates, treasuries, will then go higher. Well, if we've already had problems with banks such as SVB, Silicon Valley Bank, or Signature Bank, or others such as that, will there be other banks that will have been investing in treasuries some more, and will we even see more bank failures?
As the Fed raises rates, it tightens financial conditions and it makes things more difficult for lenders and borrowers. And so, yes, we're moving into an environment where we're becoming more and more restrictive on the economy. And that might mean credit losses on loans, particularly commercial real estate. That is an area where many regional banks are overexposed. Many regional banks in the US have 40, 50, sometimes 60% of their investments in commercial real estate, of the loans they've made in commercial real estate. That's an area with high vacancy rates and increasingly challenging funding costs as the Fed raises rates. So, yeah, it exacerbates this problem. And I'd add that as I went through this earnings season, I really listened for comments about layoffs and workforce reductions and job cuts. And I heard a lot more than I heard last quarter. In fact, the number of businesses talking about job cuts are now exceeding those complaining about labor shortages. And that could lead to maybe weakness in the job market over the course of this summer, adding to some of the concerns about credit quality.
For about commercial real estate, a number of real estate loans will be coming due at the end of this year and early of 2024. And if there's not the tenants to go ahead and fill those vacancies, then if the credit is tightening, then will lenders be willing to go ahead and to roll those loans over?
And it's interesting if you look at cities like Dallas or San Francisco or Atlanta, these are vibrant cities, but they have a 25% vacancy rate for office real estate. Very difficult for landlords to hold on to that. And they generally finance their property on a short term basis, meaning they don't have 30-year mortgages. They finance them on a 1, 2, 3 year basis. And as those rates roll off and now roll into much higher yields, given how quickly rates have moved, it's becoming much more costly for them to carry that vacant real estate. Something's got to give. And, I'm afraid that it might be more of a downturn in commercial real estate. That is a challenge here facing US regional banks. Interestingly, it's not elsewhere in the world. While the pandemic has prompted many of us to work from home, I myself work from home these days, it is not so much the case in Japan or Europe. Vacancy rates are quite a bit lower and the banks aren't as exposed. So that might be a place to hide out if you're worried about the banking risk in the US.
Yeah. Does this open, Jeff, a possibility where most real estate loans are being made by regional banks in that local area, but now you find loans lending credit maybe coming from private equity or family offices, or I mean, you're with Charles Schwab. Does this do companies see an opening that where regional banks might not be able to make the loans like they once could 1 year ago, that maybe Charles Schwab or private equity, this may open up the door for others to make these kind of loans?
Certainly, the private markets for funding for those businesses may be a viable alternative to banks, although it'll come at a higher cost. And this is one of the challenges for these operating companies, is dealing with this higher cost environment. If they're not able to push along higher rents to their customers because of those high vacancy rates, they've got to pay somebody, whether it's a bank or a venture capital or private equity firm. It's going to be more costly. I think that could squeeze out a number of the space that's currently allocated towards office, find it turning into maybe multifamily housing, or maybe storage space, or maybe a factory space. We'll have to see. There might be quite a bit of turnover in the middle in many major cities.
Jeff, so far, we're getting earnings season coming in from first quarter. And as you alluded to about the earnings, I mean, 77%, about, give or take, 77 to 80% of the companies have already reported. And they're higher than by about 7% of what analysts expected them to be, which is on a term good news. And the Federal Reserve wants the economy to slow down. Will this have a negative effect, do you think, on when they do meet again in June?
The Fed recognizes that companies lowered the bar. So they are beating by 7%, and that's great news. But earnings estimates have come down this year. They came down for the first quarter. They've come down overall for the year. For the S&P 500 this year, forecast since January for the year as a whole have come down by 4%. That's not a huge amount, but when it comes into companies, beating estimates, it's on a bit of a lower bar. I think they are recognizing that one of their main concerns, again, is wages and how quick wages have been rising as everyone sought to hire in the aftermath of the pandemic and the need for the services sector to really beef up its staffing. That seems to have started to turn around. What's interesting right now is I think we are in a recession, but it's no sequel. It's a different kind of recession. I've been calling it the last two recessions I was calling the everything everywhere all at once recessions. They didn't win any Academy Awards, but everything fell from trade to services to retail to construction, manufacturing, happened everywhere around the world, and it happened all at once. And this is very different. We went through a recession in the services sector during the pandemic. Now we're in a manufacturing recession. Services are booming. Try and book a reservation in your favorite restaurant or on an airline, but at the same time, manufacturing output is slowing, and we're starting to see that show up in some of the earnings for manufacturing firms and jobs as well. So we'll see how that factors into the Fed's calculus when it meets next month.
A number of companies are laying off people. I know Meta has laid off a lot of people. Google is laying off, and you've got quite a few companies that have laid off and are in the process right now of laying off, except that like you say, when you want to go to your favorite restaurant and such, that's always a waiting line to go into.
It's exactly what I'm talking about. About a year ago, we went from shortages to gluts of products, whether it was semiconductors or workout equipment, you name it. All those things that were at a shortage during the pandemic came back in a big way in 2022. We're now seeing that happen with labor. We were in a labor shortage environment for a long time. We're now seeing gluts of labor where companies have just found they overhired or they have too much staffing relative to the amount of demand, and they're beginning to pull back. This is across the board, but I'm seeing it maybe a bit more in manufacturing yet than in services, but it's beginning to bleed in. And as the banking sector issues develop, and I don't mean more of a crisis or more bank failures, but I mean the tight lending conditions as banks require more collateral or don't make loans to the same people they were making them to before, meaning the same businesses, maybe requiring a bit more of a stability in the businesses that they lend to. That's going to tighten credit and probably mean more layoffs, even in the service sector.
The jobs report that came out for April reported was that the age of the prime worker has gone down. The age of the prime worker is now going back into the workforce. I wanted to make sure and add that correct. So that if the age of the prime worker is now going back into the job force, my first thought, and I don't know if this is correct, but is that the stimulus money that had been shoved out into the economy so much was being dried up that now prime age workers are now going into the economy. Do you think that it's because of the lack or the spending of the stimulus money going down, or do you think that they're seeing, like what you're saying, that they're getting less and less manufacturing jobs, so I better get out the house and go back into trying to find a job?
I think what they're looking at is how much more of those jobs are being paid than when they left. There's certainly been inflation in wages. We've finally seen it in wages after seeing it so many other places. And the consequence is that is those jobs look more attractive to people who weren't willing to sell their leisure time for what they were able to get back in 2019 or 2020. Now they're finding that much more attractive. However, that wage growth is likely to begin to slow with a lag effect with overall jobs, such that maybe by the end of the year it's beginning to come back down again. But for the time being, it still looks attractive. So you're starting to see more of a glut of labor.
About the cost of labor. I know Senator Bernie Sanders from Vermont is wanting to increase minimum wage to a federal minimum wage to $17 an hour. Now, you've got many states around the country that have almost to that minimum wage right there, but people are paying much more, Walmart and others, because they want those bodies in and they're willing to pay for them. Will this kind of a federal minimum wage have any kind of an effect?
Only about 2% of U.S. workers receive minimum wage, and half of those are high schoolers, really people in their teens who aren't supporting themselves, just looking for extra money. So overall, it's not going to have a real major impact in terms of the labor cost out there. I think more importantly, we're probably headed into an easing of labor costs as the labor market begins to cool down, with a lag effect here that we're seeing in the economic picture. Unfortunately, it may not come down fast enough for the Fed to feel relief. As we start to see companies begin to now recognizing that they may have overstaffed, the first thing they do is close open positions. And we're starting to see that in the job openings and labor turnover survey. We call it the JOLTS. And it may not be till later this year that we actually begin to see the unemployment rate climb. That, again, won't provide enough relief to the Fed in the near term for them to be sure all the inflationary pressures have receded.
Well, if we're in I guess, a mild recession right now, do you find certain sectors that are better to be investing in at this moment than, say, other types of stock sectors?
Rather than focus on sectors, and there's really only been, one or two that have done really well this year and last year, focusing on characteristics. So yes, in this kind of an environment where volatility in the market is high, we're concerned about factors pushing and pulling in different directions. You want to focus on quality stocks. What do I mean by quality? Companies that have a lot of near-term cash flow. And you can find them by screening for low price to cash flow. It's a common search term on any stock screening tool, or maybe companies that pay high dividends. Usually they've got to have good cash flow and a strong balance sheet to do that. Those ways of defining a quality have really been outperforming this year and last year. You can find them across many different sectors. Even in the tech sector, you can find higher quality companies in some aspects of the tech sector. They've been outperforming the rest of the market by a very wide margin. I note that last year, the lowest 20% of price to cash flow companies actually held their value, didn't fall at all in a year where the overall market was down about 18% or so. So consider that. One other point related to that is international stocks tend to have a greater proportion of quality companies than in the US. In the US, we tend to have more long duration stocks with their cash flows way out in the future, growth stocks. So we're seeing international markets outperform this year and last year. I think that's a trend that may continue as well.
Do you think that a person who has a portfolio, and whether they be for a 10-year horizon or a 20-year horizon, how much of a percentage do you think that they should have in both domestic and international stocks?
Almost certainly they should have a higher percentage to international stocks than they do now. After a decade or more of international stocks underperforming the US market, unless you've been rebalancing back into them, they probably represent a smaller portion of your portfolio that makes sense going forward. Every time we go through a recession and enter a new economic cycle, new leadership emerges. For example, in the 80s, it was international stocks led by Japan. Then the 90s, it was tech stocks in the US. The 2000s, it was international stocks once again. And then, of course, in the 2010s, it was back to the US. I think now we're moving through this recession. Part one was in the pandemic. This is part two. And we're starting a new cycle. And in that new cycle, new characteristics are leading the market. International stocks are poised to outperform, and in fact, have been outperforming for the last couple of years. So something to reconsider in your portfolio, rebalancing back into those international equities.
Right now, we're hearing quite a bit about AI, artificial intelligence, and even I think the World Economic Forum was saying about the amount of jobs that's both going to be created and those that are going to be lost because of artificial intelligence. And you just talked about tech just a moment ago, about when we talked about how to place in our portfolio. Do you like stocks that are maybe entering into the AI arena?
Picking and choosing individual stocks based on their AI prospects is very difficult. It seems so early. I think it's challenging to do. I think getting exposure, having exposure to the tech sector is important, even though tech may not be the leading sector over the remainder of this year. It's likely to participate in overall gains, and AI is likely to play a part of that. I think I'm more excited when it comes to new technologies about the adopters of those technologies than the companies that develop them. Companies in healthcare and financial services, maybe some of the leading beneficiaries able to use AI to deliver more personalized service to their vast numbers of customers in a way that provides a better care for their wealth and their health.
So in an area of healthcare and other types of that area,
It's not necessarily the companies that pioneered the internet. It's those that really capitalized on it, right? The Googles that did so well, and the Facebooks, and those that really built a platform around that technology rather than deliver that original technology. And that's kind of what I'm focused on here.
how much how much should the government be involved in regulating this new type of AI field?
Well, clearly, there are going to be regulatory proposals put forth, and they'll likely be pretty transparent. I'm not sure the U.S. will be the first to act on that. Europe, I think, is typically ahead of the field in terms of coming up with new legislation and regulation to manage new technologies. We might get a little tip of the hat in to see what they're beginning to do. They certainly put some restrictions on social media and other things early on. It'll be interesting to see what they come up with. And then China will likely come up with something by surprise.
Jeff, what's the best kind of investment advice were you ever given?
I think one of probably the best is investing for the long term. I think it's so many investors have this idea that trying to forecast where the market's headed over the long term, let's say 10 years from now, is got to be so much harder than picking where one individual stock might go over the next week. It's the exact opposite. It's nearly impossible to predict where a stock might go, any individual stock over the next week or two or a year. But the market over a 10-year time horizon, so many factors drive that it's actually proven to be much more predictable over time. There can be no guarantees, but I think focusing on the long term is absolutely critical when it comes to investing, and make sure you have a broadly diversified portfolio, because in different times and different sectors, you're going to see different parts of the market perform well. I think that's the key to long-term success in investing.
Jeff, I had a great time. I hope you come back.
Pleasure. Thanks for having me on. This was great.
Thank you, Jeff. Well, if you have a question, maybe a comment about the show, we would love to hear from you. Make it concise, make it pithy, and write us, and notice the new email address, andre@benecapital.com. So let's take a look at the markets heading into next week. But first, what company went public today in 1997 that was advertised as the Earth's biggest bookstore? We've got that answer, and it's coming up. Well, what company went public today in 1997 that was advertised as the Earth's biggest bookstore? Amazon. In fact, since going public, over the stock has surged over 148,400%. In fact, the stock opened at $18 a share. A $1,000 investment at its IPO date would now be worth $1.5 million today. That's a rate. Target stores released their first quarter earnings this week, and theft is robbing more and more from the bottom line from the retail company. Now, while the consumer is going to their stores to shop to find what they want, so are thieves. And theft has been increasing every year from the retail company. According to Brian Cornell, CEO of Target, through shoplifting and organized gangs just going into the store and stealing, their losses have jumped by $500 million more this year than from last year. Now, if you think that this is bad, last year, Target lost $800 million due to theft and shoplifting, and this year, it's expected to increase another half a billion dollars to $1.3 billion. Overall, around retail, shoplifting is now getting close to costing stores $100 billion a year. Store managers are telling their employees to not stop them for fear of the safety of their employees and because of the fear of getting sued or bad publicity of stopping the shoplifters. Montana has become the first state to completely ban the use of TikTok. The Reboot Foundation has done a survey and found when it comes to TikTok, the average user is on the platform 2 hours a day. And 29% of young girls averaging double that to 4 hours per day. Now that's 28 hours a week based on a 7-day week. Here's a scary finding. The Reboot Foundation found that those on TikTok were having a harder time in understanding what was true and what was not. And they tended to believe what was on TikTok to be true. And 42% of heavy users said the information on it was reliable. Over 1 billion people on the earth use TikTok, and tens of millions of American teenagers are addicted to the Chinese app. And that's not our opinion, because when asked if they had to choose either giving up TikTok for 1 year or give up their right to vote, 64% said they would choose to give up their right to vote. They would prefer posting videos to voting. Target has pulled from their shelves millions of candles after reports of severe burns and cut risks. Now, these are jar candles that sold in multiple sizes. They received 136 reports of the jars breaking. Well, let's have a wrap-up on Wall Street, okay? This week, the Biden administration will be buying 3 million barrels of oil to replenish the strategic oil reserves. This after selling 26 million barrels of oil from the same reserve back in March. And the war to win viewers has never been greater. Variety this week announced that cord cutting, which is getting rid of your cable boxes, is going to streaming, is now at an all-time high. Variety reported that the United States pay TV subscriptions have fallen to their lowest levels since 1992. Hyundai and Kia have agreed to pay $200 million in a settlement with customers over their cars that are easiest to steal. It was on the Chinese TikTok app that just how to steal those cars. And chocolate milk, a long school cafeteria mainstay, could be coming off the school menu. Concerns about the amount of added sugar children are consuming. The U.S. Department of Agriculture is considering a ban on chocolate milk in both elementary and middle schools. And finally, the Oscar Mayer Wienermobile is changing its name. The hot dog on wheels is now going to be referred to as the Frankmobile. Well, that's a wrap-up on Wall Street Wrap-Up. Next week, we're going to be having a show you will not want to miss. State legislators are either legalizing marijuana or turning a blind eye. But just how dangerous is marijuana in the long term? Next week, we're going to be talking with Dr. Kevin Sabet, who was a former National Drug Policy Advisor for 3 presidents, Bill Clinton, George Bush, and Barack Obama, their administrations. You do not want to miss next week. Well, that's our show for this Friday, May the 19th. Our thanks to Jeff Kleintop with Charles Schwab for being our guest tonight. Always, though, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love and a productive week ahead. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. And remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.